Hello, my name is Jonathan Wellham, and I'm with Rocklinc Investment Partners, and it's June the 14th, 2015. I want to take a few moments to update you on two major items. Number one, just what's been going on in terms of stock market indexes, and then second, the whole area of interest rates, where we'll spend most of our time, because if you're following the news, you're probably hearing a lot about interest rates, and maybe we're at the point where interest rates will finally start moving up. So quickly, in terms of market update, so far, as we are doing this video on June the 14th, we really haven't seen much movement in the overall stock markets. If you look at the Dow Jones Industrial Average, it's up about 1% so far this year. And if you go back 12 months, back to June of 2014, the Dow Jones is up about 9%. If you think of the S&P 500, which would be a broader mix of companies, the largest companies based in the United States in most cases, but big international companies, you're seeing that so far this year, the S&P 500 is up about 2%, and that includes dividends reinvested, and over the last 12 months, approximately 10%. Now, when you look at Toronto, the Toronto stock market, where we have our probably the largest exposure, the market returns there have been very mediocre so far over both the year-to-date period and also over the last 12 months. So far this year, the Toronto market is up approximately 2%, and over the last 12 months, going back to June of 2014, we're only up about 1%. So we're actually below where we were at the beginning of this year. And that's largely because of the large drop in oil last fall and sort of the back half of 2014. So it's been tough slugging in terms of the overall equity market. That doesn't surprise us given the global challenges and some of the sort of the macroeconomic things that we've talked about many times in these updates. When you look at bonds, we've seen just a tremendous movement in terms of interest rates, which is what affects the prices of bonds. And I'll talk a little bit more about that. So at the beginning of this year, for the first 3 months or so, we saw just a plummeting of interest rates. In fact, interest rates reached some of the lowest levels we have seen in centuries, literally centuries. In Europe, over 40% of the government bonds were actually trading at negative yields at one point. That means you actually buy a bond and get back less than what you invested, which is, crazy, and is indicative really of the monetary problems and the stress of all the debt that we have around the world. But over the last month and a half, 2 months, interest rates have really come back up, and they're back to where they were at the beginning of the year, and in many cases actually above that. And so it's raising this whole issue of what's going to happen to interest rates. Is the Federal Reserve, the big central bank in the United States, going to put interest rates up? They're going to be meeting this week. And so I wanted to talk a little bit about how we are positioned in regards to interest rates. And if interest rates are going to move up a little bit, what does that mean for the valuation of bonds and then stocks? Okay, so I want to shift over and just talk a little bit about that. When you think of the impact of interest rates on bonds, what is the impact? Well, when you have an interest rate increase, the value of bonds is going to decrease. When you have an interest rate decrease, the value of bonds is going to go up. And so it's really an inverse relationship. And why does that happen? And I want to give you hopefully a very simple example that you can follow. If you take a $1,000 bond that has a 1-year life, so just a 1-year life on a $1,000 bond, and it's supposed to give you 10%, what's going to take place here? Well, you buy the bond for $1,000. In a year, you're going to get your bond price back, the $1,000, plus a 10% return or a coupon. So you'll get $110. There's your 10% rate of return. Now, if interest rates go up to 20%, what's going to happen to the price of that bond? Well, the price of the bond should drop, because now that bond is supposed to produce 20% rate of return. But the coupon is still 10% or $100. So what has to happen is that bond needs to drop by approximately $100. So instead of being 1,000, it'll drop to 900. And then in a year's time, you'll receive the full $1,000. The price of the bond will increase, and you'll get your coupon of $100. So you'll get a $200 rate of return on that $1,000 bond. And I'm using, again, approximations here. So you'll get your 20% rate of return. Now the key is interest rates went up, the price of the bond dropped. Let's look at one other example just to drive this point home. If interest rates, which were at 10%, dropped to 5%, what would happen to the price of the bond? Because now all you're supposed to earn over that year is $50, and yet you're going to get a coupon of $100 at the end of the year because it's that bond, that $1,000 bond has a 10% coupon. Well, what's going to happen is the price of the bond's going to go up to $1,050 approximately. So that over the course of the year, you're going to lose $50 on the bond, but you'll gain $100 on the coupon. And so net, you'll earn $50, which is about 5%. Now, the reason I just walk you through those illustrations is because as interest rates go up, the value of financial assets generally is pushed down because you're going to need a higher rate of return, and the cash flows coming from the bonds or from stocks for that matter ultimately are going to have to be adjusted. And so when you think of interest rates and the impact on financial assets, interest rates go up, financial asset values are pressured down, and then vice versa. If interest rates are dropping, financial assets go up. And so over the last 30 years, if some of you who are old enough to remember the early 80s when we reached a peak in interest rates, we have really been on a 30-year drop in the interest rates, and that has really helped propel stocks and bonds and financial assets, homes, real estate, all of these investments. And so the issue now is if we are starting to move back up and getting more of a normalization of interest rates, which will be a challenge given the debt, but just say that that is the case, then we're going to have pressure on the value of bonds and also on the value of stocks. Now, what are we doing about that? How do what should be a reasonable strategy in light of that? Well, let's think about it in terms of bonds, and then I'll talk about it in terms of stocks. When it comes to bonds, if interest rates are starting to move up, what do you want to do? You want to own high quality bonds, and you want to own short-term bonds, because interest rates as they move up will have very little impact on short-term bonds. The bigger impact is going to be on the long-term bonds. And that's why when you look at your portfolio, you will see very high quality names, number one, in terms of any bond holdings. And number two, you'll see that the duration or the length of that bond until it matures is very short. In most cases, it might be 2 years. And what that is going to enable us to do is if interest rates go up, then as those bonds mature, we'll be able to reinvest those proceeds at higher rates of return without taking capital losses. And so we're well positioned if interest rates go up in terms of bonds. So any small movement down, don't worry about it, because in fact we're better positioned and are quite happy if interest rates actually go up a little bit. It'll give us much better returns over the next sort of medium to longer term. When it comes to stocks, if you have a high dividend paying stock, for example, if interest rates come up, it will put pressure on the value of the stocks. So some of our infrastructure businesses, some of our real estate companies, banks, different financials that have high dividends, if interest rates come up a little bit, then that dividend won't be worth as much, and it'll push down the value of the stock a bit. But don't worry about it. I really emphasize this, that the key here is if we have stocks that maybe they come down a little bit because interest rates are going up, but these are growth companies. So what happens is they have strong balance sheets, they continue to grow their business, and over time they will grow their dividends to more than compensate for the increase in the interest rates, and that will restore and allow the growth in the value of the business over time. And so we have selected stocks that have strong balance sheets. The dividend payouts are very, very conservative, so there's room to increase them as interest rates go up. They have a dependable revenue stream, and the the earnings of the business continue to grow, so we're well positioned. I'll give you one example of how this works. Back in January of 2009, if you bought Brookfield Infrastructure Fund, which is a holding for almost all of our clients, I think all of our clients have it, Brookfield Infrastructure would have been trading at about $13 US, and it was paying a dividend at the time of $1.12 US, so you're getting 8% rate of return in terms of a dividend. Today, Brookfield Infrastructure is trading at about $43 US, so that's up about 230%, and its dividend has more than doubled to $2.12, so it's paying about a 5% yield. And so we want to find companies that, yes, they might be under pressure in the short run if interest rates go up because there's competition for that dividend, but they are growth companies. They can grow their dividends. They can expand the value of the business even if interest rates are going up slowly over the next little while. So I just wanted to make a few comments about interest rates. You might see volatility in some of the stock prices. It does not deter us. We are well positioned in terms of both our bonds, our stocks, for companies that can weather a backup in interest rates, at least a backup to a more normal level if that's what is going to take place over the next little while. And so any volatility does not bother us. We can actually take advantage of it, buy more of our favorite companies using the cash on hand or the movement between bonds and equities if that's appropriate in your portfolios. The last point I just want to make is just a couple of administration points. I want to mention that Paul Ferrugia, who's been working with Rocklinc now for over 2.5 years, has been accredited by the Ontario Securities Commission as an associate portfolio manager working under my jurisdiction. And so Paul, congratulations to Paul. That allows him to give direct advice in terms of investing to clients and to work even more closely with me, and I appreciate the wonderful work that he's doing. I've also added over the summertime one of my twin boys, Jonathan Wellham Jr., and he has been helping out in some marketing, advertising area in terms of our website. You'll see a few new additions to the website over the next few weeks. And we've also added a Facebook page, which will focus really just on financial articles, and also some of our updates we'll be able to post there. So if you're on Facebook, you'll be able to go to Rocklinc Investment Partners, like us, and you can follow some of the updates that I will pass along, both from the newspapers and from the broader marketplace, and also our own updates from Rocklinc. So again, if you have any questions at all, please do not hesitate to contact us, email, stop by the office, and we'll be in contact with most of the clients over the next couple of months anyway. And so hopefully that update has been helpful, and we are well positioned for the choppiness that we would expect in the marketplace going forward. Thank you very much. Bye now.